The trend is your friend. You've heard it 1,000 times. But here's the uncomfortable question. Is it actually true, or is it just a slogan that survived because it rhymes? Before we go further, one thing up front: this is educational commentary, not personalized financial advice. I'm going to show you the mechanism, the numbers, and the exact places where this saying breaks. What you do with that is on you. Let's define the claim precisely, because vague slogans hide bad trades. The trend is your friend really means one thing in math terms: that returns have positive autocorrelation over some horizon. In plain English, a market that went up recently is slightly more likely to keep going up than pure chance would suggest. That's it. That's the whole idea. And whether it's real depends entirely on the time frame you're measuring. Here's where it gets interesting. Over medium horizons, roughly 3 months to 12 months, momentum is one of the most documented effects in all of finance. Academics have found it across stocks, commodities, currencies, and bonds, going back over a century. The winners of the last year tend to modestly outperform the losers over the next few months. That's not a slogan. That's a persistent statistical edge that shows up in market after market. But now flip the time frame and the friend turns on you. Over very short horizons, a single day, or 1 to 5 days, equity index returns often show slightly negative autocorrelation, meaning an up day is marginally more likely to be followed by a pullback. And over very long horizons, 3 to 5 years, you get mean reversion, where the biggest winners tend to underperform as valuations snap back. So the same market is trending, choppy, and reverting all at once, depending on the lens. So why does medium-term momentum exist at all? Because markets are made of people and flows, not equations. Point 1. Information diffuses slowly. When a company or a macro theme shifts, not everyone updates at once. Big funds scale into positions over weeks because moving billions instantly would move the price against them. That gradual buying is literally what a trend looks like on a chart. Point 2. Behavioral anchoring. Humans underreact to news at first. They anchor to the old price and doubt the move. Then, as the trend continues and headlines pile up, they overreact and pile in late. That underreaction then overreaction cycle creates a predictable arc, a slow build, an acceleration, and eventually an overshoot. The momentum trader is really just harvesting the gap between how fast information arrives and how slowly humans accept it. Point 3, and this one is mechanical: passive flows and systematic strategies. A large share of daily volume now comes from funds that buy simply because prices went up, and volatility targeting strategies that add exposure when things are calm. When a market grinds higher with low volatility, these programs mechanically buy more. That's a feedback loop. It's not sentiment, it's plumbing. And it's a big reason trends can run longer than any fundamental story justifies. Now the part almost no one talks about. The exact same mechanism that builds a trend is what makes its collapse so violent. Volatility targeting works both ways. When calm breaks and volatility spikes, those programs are forced to sell to reduce risk, and their selling raises volatility, which forces more selling. That's why trends don't die of old age. They die in a few brutal sessions. Think February 2018, when a low volatility grind ended in a 2-day crash that wiped out months of gains. So when is the trend not your friend? First, at volatility regime changes. When VIX jumps from the low teens into the 20s or 30s, autocorrelation flips. The market that trended for months starts whipsawing, and trend-following signals generate loss after loss. Second, around known catalysts: a Fed decision, a CPI print, an earnings release. The options market tells you this directly through the expected move. If a stock is pricing a 7% move around earnings, the prior trend is basically irrelevant into that event. Third, at extremes. When an asset is stretched multiple standard deviations from its moving average, and everyone already agrees on the direction, you're no longer early in the diffusion cycle, you're at the overreaction end. That's where reversion lives. The math edge of momentum is strongest in the middle of a move, when doubt still exists, and weakest at the euphoric or panicked extremes where the slogan is screaming loudest at you. Here's the point of view I want you to leave with. The trend is your friend isn't wrong. It's incomplete. It's true on a specific time frame for a specific reason, and it fails in specific, identifiable conditions. Treating it as a universal law is how retail traders get chopped up. They apply a medium-term truth to a 5-minute chart, or they cling to a trend right through a regime change that already flipped the odds. So what does a disciplined trader actually do with this? They match the tool to the time frame. If you're trading momentum, you commit to the horizon where the edge exists, and you stop pretending your intraday noise is a trend. They respect volatility as the master switch. When the regime changes, the strategy changes, no ego. And critically, they size positions so that the inevitable violent reversal is survivable. The edge from momentum is small and statistical. It only compounds if you're still in the game after the bad month. Position sizing is what converts a real edge into real results, not the slogan. One more layer, because this is where discipline meets execution. Before you lean on any trend, check what the options market is pricing. Implied volatility and the expected move tell you how much surprise is already baked in. If implied vol is cheap and skew is calm, the feedback loop that fuels trends is intact. If vol is rising and skew is steepening, the crowd is buying protection, and that's your early warning that the friendly trend is about to get moody. You don't have to predict the reversal. You just have to stop assuming the trend when the data says the regime is shifting. So the next time someone tells you the trend is your friend, you'll know the full sentence. It's your friend over the medium term in a calm volatility regime, away from the extremes and away from major catalysts, and it's a stranger everywhere else. If you want more breakdowns that give you the mechanism instead of the slogan, subscribe. That's the whole mission of this channel: signal, not hype. Trade the math, size for survival, and let the trend be a friend you never fully trust.